All right, Julian, we're looking at one of those long-time companies, Coca Cola. Their results are out. What are we looking at for Coca Cola this year?
So Coca Cola for their 9 months ended September.
We're barely hearing you, Julian. I don't know what's going on with your audio.
One sec.
Yeah.
Better?
Yes, that's the side with the
Yes.
mic. You had in the wrong side.
Why, Kalilah, you have to roast me like this. Okay. So the company is not doing badly at all. So as at their 9 months ended September 2023, net profit after tax is up 16.4% year over year, while revenue is up 6.2% year over year. So that big gap has a lot to do with not just revenue growth across segments, but the fact that the company has maintained its operating efficiency, especially improving its gross profit margins. So the company has been able to manage its input costs, and last year would have seen much higher commodity costs across the board, specifically around food items, things related to sugar, things related to inputs that would be imported. But as supply chains have been relaxed, what we found is that companies like Coca Cola have been able to get better gross profit margins, and that fed right through to the bottom line of the company. In terms of the health of its capital, the company is rated A grade by Fitch Ratings Agency with a stable outlook. So it's not just a company that's doing well in terms of profit and loss, but its capital base is also healthy. In terms of the operating segments, North America is still a leading segment, not just in terms of growth, but in terms of the market that carries the company as it relates to sales, followed by Latin America, then Asia. But just to add some additional color around what Coca-Cola does, the company covers brands such as Fanta, Schweppes, Sprite, and Minute Maid. And in terms of partnerships, the fast food chains that carry Coca-Cola includes McDonald's, Wendy's, Burger King, Subway, TGI Fridays, Domino's Pizza, and Chick-fil-A. So it actually has more fast food partnerships than its nearest competitor, which is Pepsi. And Coca-Cola is different from Pepsi also in that Coca-Cola is more dominant in the US than in international markets, while Pepsi is bigger in international markets than in the US. So in terms of the stock, the price is at $59. The PE is 23.9 times, and that's cheap for a return on equity of 41%, which means that the company is very productive and efficient in terms of its operating performance. And at the price of 23, a multiple, the valuation of 23.9 times, that's fair. How it has performed year over year, it's actually down 7.7% year over year. It's down 6.6% year to date. And in relation to the 200-day moving average, it's flat. However, the stock has been on the move in the last 50 days, being up 5.6% relative to the 50-day moving average. So the stock is on the move, even though it has been down year over year and year to date. And the dividend yield is 3.08%. So it's a good dividend opportunity, especially compared to the rest of the S&P 500. It has a strong track record, strong partnerships, and it's doing well year over year. So Coca-Cola is justified in Warren Buffett's portfolio to this day.
It feels like Coca-Cola is one of those companies that people just never stop drinking Coke. But then again, who knows? The world is changing. People are seeking healthier lifestyles. You never know when that flip might switch.
That's true. Well, the good thing is the company also carries brands like Powerade, and they have their own water brands. So I believe that Coca-Cola is likely to continue investing in brands that are not as concentrated in sugary drinks that are unhealthy, as we know. And I anticipate that the brand will continue to invest in these lines that are more in line with where health trends are going, as you identified.
Shelly-Ann wants to know, what's the analysts think about EduFocal's planned stock split at 161? Anybody want to take it?
Okay, I'll take it.
I
I'll
haven't
take
been
it.
following
Screenshot.
it closely.
Yeah.
Yeah.
Okay, so I don't have the full terms of the split, but I can talk about EduFocal a bit because I think the company is in its early growth phase, meaning that based on the type of business model it has, it it should see its best days further down the line because the company is just taking off in terms of its growth. It's basically a technology company, so it's more similar to a Tesla, for argument's sake, because we were mentioning Tesla in the earlier conversation. So it's more like a Tesla than a Ford in terms of its life cycle. So this company is likely to see its best days ahead because it's still in the innovation phase. It's still disrupting a traditional business model, which is in-class tutoring. So more so, um, we expect the value to come more from the business model taking off and maturing over time than a split in one specific period versus another. The benefit, however, is that EduFocal tends to have a core audience. So there are persons who believe in EduFocal and hold on to EduFocal, and it allows EduFocal to trade a specific way. So that creates a price floor. So if anybody is going to sell it, then there's an audience that is willing to buy because of that core following. And those two things combined is good. It's a good thing to have. A core audience, which is a catalyst, as I mentioned just a while ago, and of course the fact that your business model is still in a young phase, and it has shown proof of concept, so it has been profitable in the past, and there is proof of demand, and there is proof of concept, and the leadership is experienced. So all these things combined actually should extend the longer term expectations around the stock as opposed to where a split is going to be in the period. But I think the split is inconsequential to the things that were just mentioned a while ago.